Lenders face an uphill battle to fill the SMB financing gap. Small to medium-sized businesses. That's the financing gap. Not going to pronounce his name correctly, so I'll go with Richard Zhang, Forbes council member, wrote in a post yesterday dated January 27th that I wanted to talk about today. I thought it'd be fun just kind of go quickly through the article, a little bit of my thoughts. I read through it briefly, so don't hold me to anything. It's just my kind of thoughts that came out of the top of my head, and figured if you haven't come across the article yet, it's a good one. And there's a kind of a broader point of view here from obviously his experience and his background. Angel investor, fintech expert, co-founded 2 lending startups, 7 years SMB financing consultant, etc. All right. So he starts off with the global small business loans market was valued at $2.46 trillion in 2023. However, banks and credit unions approved less than 25% of loan applications. So I've heard the percentage. I think it changes from year to year. It's still very, it's still always been low, but this kind of reinforced it again, as far as probably the most recent number I've come across in a little bit. Only 25% of loan applications. So this is basically where that slogan that everyone gets, that's like, oh, when banks say no, we say yes. That's where this comes from. Okay, so he goes on, alternative lenders, mainly fintech platforms, have emerged as promising solutions to bridge this financing gap. These digital-first players, leveraging big data, automation, and AI, have the potential to radically reshape lending. Of course it does, Mr. Zhang. You might think these fintech lenders would be venture capital darlings with significant market traction, but that's not the case. From what I've seen, the SMB lending sector has struggled to attract venture funding within the broader fintech space, and with most VC capital flowing to payments and personal finance. It is pretty interesting, right? Because when you think about the sector, including fintech, small business lending, funding, all the MCA funders, revenue-based financing, how it's expanded, and so forth, and venture capital really is not backing them much. So moreover, he says SMB lenders tend to receive poor customer ratings. Now, this is very interesting and not something that people talk about a lot, right? So according to a 2023 survey by Fed Small Business, only 15% of approved loan applicants are satisfied with online lenders, compared to 74% for small businesses, small banks, and 53% for large banks. Now, whatever, we'll take that and for, this survey and go with it. But it is something I brought up probably a couple of years ago now. Like, no one, people use Trustpilot and other Google reviews and Yelp and all that. But there is a lot of crap in those reviews, a lot of fake reviews, a lot of BS, all right? A lot of incentivized reviews. They've gotten better, I think. But, who are those lenders, funders of any sort that are putting out internal review reports, net promoter score? If you know what a net promoter score is, it's basically when you're surveying the client, the customer on 1 through 10, or they're given a rating of 1 through 10, and whether they would refer them to someone. An 9 and 10 is the best, 7 and 8 is, I think it's the middle ground, and then 1 through 6 is basically below par, right? So it's like, what could we have done better? And so I haven't gone through that a little bit, but it is something that's very valuable as a tool to find out where you're at with in the minds of your customers. And you don't see many funding companies, direct lenders, sharing that information out there in the public. They just kind of push out their Google reviews, Trustpilot reviews, and all that other stuff. Then he goes into a section called Static Model and Exclusion. This is a significant issue, as he points out, particularly for lenders in their early stages. They're not as digitally smart as you'd expect, and they tend to adopt a one-size-fits-all approach with standardized static eligibility criteria. This inadvertently excludes many potential borrowers and effectively reduces their TAM, their total addressable market. I can see what he's saying there. I mean, I think it just depends on who he's looking at. He obviously has a ton of experience. So there's lenders, whether it be, the big guys, PayPal, Stripe, or, like a Fundbox, which we'll get to in a minute. Other, he talks about a couple others here in a second. For instance, despite way more simplified documentation requirements, I've noticed that many fintech lenders still expect borrowers to be U.S. citizens and or have Social Security numbers. But the fact is, almost 20% of new businesses are founded by immigrants. By excluding these businesses, alternative lenders miss out on a huge lending volume annually, considering that 40% of small businesses applied for a loan or line of credit in 2022, and the average business loan is around $100,000. So I'm not going to do the math there, but I trust him on. It's a big opportunity, right? So there are some people that fund I-10 and other green card status holders and that sort of thing. But I think he's right, and there's probably a lot of other things that are excluded from these stringent underwriting, credit models that he's not touching on here. That probably could be brought up on a different video that. We'll see how they change in the near future, different states, regulations, that sort of thing. Moreover, many SMBs, especially home-based businesses, find it difficult to open a traditional business bank account, which often requires a physical business address. This presents a significant hurdle given that 50% of all businesses start at home. I'm not really sure I agree with him on this. Wherever he gets this number, 50% of businesses all start at home, that's fine. But I got a business bank account, my first one, like 8 years ago, and it was a home-based business selling, stuff online. And that was Bank of America. I use Bluevine now. So when he says traditional business bank account, I think the word traditional is key there. Tradition is changing. Banks like, Bluevine, like Novo, some other banks that, are mostly online are legitimate, and they, are FDIC insured, etc., that they can, get a business owner an account, given some basics. The premise and pitfalls of embedded finance. So embedded finance, obviously a huge deal now. Recently, vertical SaaS companies that work with SMBs have begun offering embedded finance solutions to improve inclusion by addressing various issues pertaining to small businesses in their niche markets. These SaaS platforms have access to vast amounts of small business customer data, enabling them to assess risk and offer embedded lending solutions tailored to their unique business needs. For these SaaS players, lending isn't just a secondary revenue stream. It's a way to improve marketing, drive sales of their core products. They can potentially lower lending requirements and offset losses through cross-selling, upselling, and other products. He goes on to talk about, this approach is promising, but comes with its own challenges. Business owners are extremely busy. Yes, we know. The field lenders are pushing unnecessary products. I don't know what that has to do with. Well, I could see there's going to be distraction, but like if they're in the process of getting a loan, if you're trying to upsell them on like a CRM or like a phone service or something, I don't know, whatever it may be. I mean, yes, it can get too much, I guess, but I would wonder how successful they are, and then what the customers think about that, rather than just kind of like conjecture. So he talks about while offering multiple financial products like insurance or wealth management. I guess that's probably where he's going with it. Well, that is where he's going with it more so than the other ones I mentioned. It also could raise conflict of interest concerns at the same time, potentially creating regulatory concerns. Now that's interesting, so I on that level, I haven't heard anything regarding conflict of interest in services, but something maybe to keep an eye on, for the embedded guys. And embedded, like Fundbox, I think I mentioned them earlier. That's an they are mainly embedded finance now. So here's where it gets a little bit more interesting for those closer to the revenue-based financing, short-term loans and lines of credit. As for SMB lenders' bottom lines, securing bank partnerships and assessing their cheaper deposit funding isn't easy. It requires time, etc., loan origination, underwriting, and repayment cycles. In the early stages, fintech lenders typically fund loans from their own balance sheet, a very capital-intensive approach that cuts into margins. So as they mature, They tap into warehouse financing from banks and private credit funds, lowering their cost of capital, improving scalability. That's what everyone wants. No matter where you're starting as a funder, where you just were a broker, doing syndication, funding, your cost of capital is very high. How do you get it lower? You got to have everything, a history, a record of successful origination to repayment cycles. So then he talks about securitization note packaging, which is packaging loans into ABS or asset-backed securities, shows promise but remains largely untapped in the SMB space. So what his SMB space, what he considers that may be a little bit different than mine. He probably definitely needs to talk about the top tier, top 20%, because he says, on deck, a pioneer in the SMB lending space, closed out a $175 million ABS or asset-backed revolving credit facility in 2018, but such moves remain rare. Rare, define that, but I guess there's probably a handful that I can think of that we posted on our site, per year in the last few years. So yeah, I don't know how often it's supposed to happen, but there's only a few when you're saying in relation to on deck. Yeah, there's only a few per year, 5, probably 10 at max. Without a more developed securitization market for SMB loans, fintech lenders must rely on costlier funding sources. This reality has kept interest margins low and unit economics less attractive for equity investors and liquidity backers, crucially needed for scalability. It's interesting because I just actually met an investment banker at our golf outing, the RBFC's golf outing, and our reception that we had after, and I actually spoke to him on the phone today. And this is kind of one of the conversations that was coming up, because this is what he does, is fund credit facilities for funders. And there's a market there for more of these players to come in and to fund. And then just to, kind of wrap this up, he talks about IT and security. The risks that come with it. I think everyone knows that, the CrowdStrike outage last year, it's how big it is. I think you go into fintech lenders, I don't know if I've heard other ones that are, that were big recently, but that's certainly a risk, as it always will be for now until eternity. So he says lenders have a long way to go. There's still a gap, which is, it's kind of, it's just surprising that there is a gap that people talk about, and they have the data to essentially prove it, where there is, the market's going to be growing exponentially or whatever the next 5 to 10 years, because everyone uses the same line, like, oh, there's, so many small businesses, and this is regulators, owners of businesses or funding companies, brokers, etc., talk about there's, businesses can't get funding, can't get loans, and on and on. But there's hundreds and hundreds, if not thousands, of lenders out there for the small business space, right? So who's missing out? Where are those deals that people are missing out on? Some of what we talked about here, but I'm just wondering where the point is going to be when that gap closes to an extent to where everyone's like, all right, we're done with that gap. No more gap talk. Let's just talk, innovation. So he talks about all the different, he says to specialize deeply in something is going to be helpful. So he says, as loans increasingly become commoditized, alternative lenders must focus on addressing burning SMB funding pain points and specialize deeply in them. So he says, whether it's medical equipment, financing, working capital for restaurants, working capital, being the top player with the most streamlined and efficient, lending process in the niche sector with position lenders, will position lenders for long-term success. I would agree with that. I think there is something to that, the commoditization for sure, and then specialization is going to be key, because that's just the way to stand out in a I believe, a crowded market. He says as the market matures, so forth, alternative lenders may play an increasing central role in SMB financing. As the market matures and new solutions emerge, alternative lenders may play an increasing central role in SMB financing. Let's come back to that. However, they must successfully navigate the complexities of user interfaces and user experience, as well as regulations and economic models, to reach their full potential. The road ahead may be challenging, but the opportunities are substantial. for those who can successfully address the barriers that stand in their way. All right. I don't know. I mean, I think alternative lenders are playing, he says playing an increasingly central role. I think they're already central, honestly. I mean, from banks and credit unions, they're really not the small business lending. I mean, they like the SBA's changed rules recently. They're still, a big part of it and like but I mean, the world, that I live in, I think alternative lenders are becoming like the go-to. They are the central piece, right? Obviously, the companies that are in position to get those SBA loans, to get a traditional bank loan of some sort, they have the time. When they have the time, they will go that route to get the cheaper interest rate. But even interest rates right now are, 9, 10%, 11, 12% for an SBA loan. We're just using that as a benchmark. And there's, some alternative lenders that can get basically the same equivalent rate or very close to it, the top tier. So that's it for this article. Comment below. Let me know your thoughts. I really want to hear, what you're thinking as far as the overall picture that he gave. What did you agree with? What didn't you agree with? Drop a comment in the comments section, and let me know any other questions. All right. So hats off to Mr. Zhang for this article, and we'll be doing a couple more of these per month, maybe weekly. So we'll see you on the next one.